Welcome to Market Signals. I'm Kristian Kerr, head of macro strategy at LPL, and I'll be your host this week. Well, we're coming off a bit of a volatile stretch in the equity market. The NASDAQ 100 dropped more than 4.5% last week. And on Friday alone, we saw the biggest single-day point drop in its history. And that was really on the back of the sharp reversal in the momentum factor. And that's what we'll be talking about today, factors. Because if you look past the headline index moves this year, there's been a lot going on underneath the surface. And a big part of that story is what's happening in the equity factor universe. So to help us break it all down, I'm joined by my colleague, Tom Shipp. Tom is LPL's head of equity research and our in-house expert on all things factor related. So I couldn't think of a better person to help us make sense of what's been driving these moves. Tom, how are you? Welcome to Market Signals.
Thanks, Kristian. Happy to be here. And yes, absolutely a pretty wild tape we've seen just year to date, not even halfway through, but lots to talk about, lots to unwind. And this is where factors can really help explain and dissect risks for you. So I'm happy to talk about it.
Totally agreed. Really good to have you on. Some big moves over the last few days, and I think a lot of it can be attributed to what we've been seeing in factors. So some of the extremes we're seeing on the quant factor side, really. But before we get into that, let's take a step back, maybe set the stage. So Tom, can you give the audience an overview of what factor investing is and how it's been really growing in importance over the last few years?
Yeah, I'd say so. Factors have a pretty long academic history, but definitely, like you said, in the more recent years, it's become very prevalent to look at factor risk, to look at factor exposures, to maybe invest solely in a specific factor exposure. But what are factors? It's really just characteristics, right? Different risk factors or characteristics within an equity portfolio. I mean, there's factors across different asset classes, but here we're talking equity factors, and that was really where the original research had been done. The easiest way to think about it is you have a bunch of different characteristics such as value or quality or momentum or volatility, and those characteristics can really explain. You may have a portfolio of stocks that looks diversified across different sectors, but the number one thing and why I think it's really relevant today is that these factors can help explain where you may have correlated risks that you don't know about, right? You have, sector diversification, but you're all actually loaded up on beta and momentum. So at a high level, I would just say factors are simply characteristics that explain what risks you're taking in your portfolio beyond just market risk.
Yeah. So really like isolated variables, right, that are driving things. That's kind of another way to think about it.
Yeah. So if you put on your stats hat, right, you kind of go beyond a single linear regression and you start thinking about a multi-factor regression that says, hey, these are multiple different things that are explaining the outcome of the portfolio.
Okay. All right. So thanks for that. So let's get into the meat of this conversation. This year I think has been really interesting. We started the year with this big rotation kind of right out the gates, away from Mag 7 into things like small cap and value. And that really was the big theme up until the conflict in the Middle East kicked off. There was then a little bit of what I would kind of call a classic risk off. And then from the end of March, we got this absolutely historic rally over 2 months that was led by a really small subset of stocks. So Tom, can you walk us through what's been happening from a factor perspective during all this? Like what's been working, as I think what's been going on in the equity factor space is really big. It's really been a big part of the story that the index is kind of masked.
Yeah, it's been pretty wild since that. I think March 30th, let's call it, end of March, the news flow from the conflict in Iran started to go from live kinetic war to a ceasefire talks and peace talks are right around the corner. And what I think is really funny about the market in 2026 is that it seems like the market itself has a very short attention span, and it's kind of a analog for society writ large, I guess. But the market almost wanted to stop focusing on the war, stop focusing on oil flows and the Strait of Hormuz, and the story went right back to the prevalent theme of the last 3 years, AI and AI CapEx. And one of the things that started to drive that was earnings, right? And I've spoken on this topic with Jeff Bookbinder and others on this pod. Just the earnings were fantastic coming out of the tech sector and the AI trade writ large. So those things started working again. And when I say working, it was pretty dramatic, the spread between your high momentum stocks, your high beta stocks, your high volatility stocks, and then their counterparts of low momentum, low volatility, et cetera. It's I don't have the numbers in front of me, but I think the high beta factor is up 50% since the bottom in March, while low vol is not really worked at all. So it's been those factors really explaining what's going on in the market, and it's really just been everybody crowding into the same theme, the same thing at one time. And that's really where I think the factors can start to help folks understand what risk they may be taking when they're buying into both semiconductors, AI, data center build out, beneficiaries of AI. It looks more and more like it's all the same trade. And that's really where you can have risks in the market and risk in your portfolio without maybe realizing it. But I'll also say that there's a large part of the market that I think wants to take that risk and doesn't want they're fully aware of the risk that they're taking and they want it, right? But I do think there's likely a large cohort of call it active managers who are diversified but are probably have a lot of that risk in their portfolio as well, and maybe they know it, maybe they don't, but I think there's a difference between those folks as well, and then folks who are maybe call it retail, maybe more hedge fund focused, but going all in on that bet, knowing they're taking that bet.
Yeah, so they might be taking a factor bet, but not realizing that they are, right?
Yeah,
a lot of participants in the market, I think. But you hit on a good point on the AI side. Like there is this bit of circularity within AI. So how you kind of hit on it a little bit, but how much of that? Like how much of the AI circularity do you think is really just driving all these factor moves we've been seeing, particularly over the last, call it, year?
Yeah, I think there's the circularity aspect. I'll go a little broader and then we can dive into the circularity, but it's really the same theme in terms of there's all this money flowing into building data centers and building out compute to help companies adopt AI to drive all this productivity that's right around the corner, that there's all this demand for these tools that's currently right here, but nobody's really paying for it. So there's a lot of different things going on with that. And I think when it comes to factors and how we can think about that is looking at the correlation of, say, momentum or beta with a factor that usually you want the low end of is investment intensity or CapEx to sales, right? So how much capital is being spent relative to your sales. So it's just a characteristic of a stock that says how much are they investing. And typically from a long factor or a long history of performance, you want to see, you typically see low CapEx to sales, low investment intensity as a winning factor, right? But in the recent tape, it's been flipped on its head. The more companies are spending, the better they're doing, and that kind of comes back to that circularity. Is all this money is coming into these stocks, it's then rotating through to the semiconductor stocks, the infrastructure stocks. Then those big spenders are raising debt, raising equity, and kind of goes on and on. And this is look, we've seen this movie before, so I think it's one of those things that investors just need to keep an eye on and have a understanding of it, particularly from a tactical standpoint of, we know that these factors can, particularly beta and momentum, have pretty violent unwinds.
Yeah.
But so you've got this big thematic, macro trend going on that is driving the earnings revisions, which is, keeping the momentum factor working. And that's where the circularity, I think, starts to kind of show itself the most.
Yeah, basically you're getting to the point there could be crowding, right? And you get to extreme crowding, and there tends to be, at a minimum, tactical unwinds and potentially even something more. I did want to circle back on, you mentioned kind of the equity market wanting to look past the events, the things going on in the Middle East. And clearly that's kind of been the case in the equity market, but it hasn't been the case in the bond market, right? Bonds have been fairly, for the most part, trading in lockstep with kind of crude prices. So, I guess from a factor lens, how how does the macro backdrop play into it? So things like rates, inflation expectations, growth surprises, obviously the geopolitical stuff, it seems to be, because there's a lot of factors that are kind of more rate sensitive. So how do you think about it from kind of the broader macro lens?
Yeah. So just in general, a lot of the core factors that folks will look at and focus on are extremely sensitive to the macro backdrop, right? If you've got a low inflation, high growth, and low interest rate environment, that is like fuel for a momentum and a beta factor, right? On the long end. Just given that you've got a lot of growth companies that have long duration of their cash flows, right? You've got this market that is going to pay up for that growth because there's lower interest rates, and so generally what you would see is, as those things are more benign, growth is fine. There's not a growth scare in the market. Those factors will do quite well. On the flip side, in a higher rate environment or higher inflation, you're going to see, more strength in quality and value, right? A value stock typically is cheap, so therefore you're not paying for long duration cash flows. You're paying a lower multiple, meaning you're not discounting a bunch of potential earnings into the future. And in terms of quality, in an inflationary environment, you want to lean on quality because quality companies are typically not economically sensitive and have stable cash flows, right? So you can kind of count on your Walmart, for example, or whatever, to have those consistent cash flows kind of regardless of the economic market. So the macro backdrop typically matters quite a bit, right? And you can even go back to the CapEx to sales, your investment intensity. In a higher rate environment, you're generally going to have, a harder environment to invest capital as a company. And so you would typically think that higher rates, higher inflation, an uncertain macro backdrop would kind of hurt all the factors that have been working this year. Not the case, because the one macro theme and trend that is overpowering all of that is AI.
Yeah, no, it makes sense. And good reminder, though, that, the macro does matter, even though we get in these regimes where it just seems to be focused on one or two factors that are really driving things, but that can very easily change, right? And maybe we're starting to see the beginnings of that with the employment data we got on Friday. Who knows? But it is a good reminder. But let's talk a little bit more about momentum, as the moves of momentum have just been extraordinary recently. Last I looked, performance and momentum was 90th percentile on a 5-year look back. What does that setup tell you? Are we at risk of seeing some sort of bigger unwind momentum stocks? And what would cause the current factor regime to change, momentum to stop working? And Tom, maybe before getting into that, if you could quickly define what the momentum factor is, because I think that's a little bit misunderstood by people as well.
Yeah, I think it's misunderstood because there's generally a few ways to explain it, but I say the most popular, most commonly used, and kind of the basis of the original paper on momentum, academic paper on momentum, was looking at just simple price returns of the last 12 months, excluding the most recent month. So you call it 12 minus 1 momentum is generally your most commonly used momentum factor kind of equation or calculation there. And all that's basically saying is winners continue to win, right? So if your stock has been winning, it tends to continue to win. And there's a few behavioral reasons behind that. When it comes to the performance of the company, right? So you'll get some good news. A bunch of investors flock to that good news and buy the stock and bid the stock up. But news generally, and this has been something that you would expect to have kind of, become an anomaly that would kind of get arbitraged away quicker in this fast news environment. But if you just throw more news, then there's just more fuel for that. So you typically have investors that might be slow to react or slow to buy in, whatever it may be. And that's just one of the reasons why, that could potentially explain why momentum has tended to exist. So you're generally thinking about price performance when looking at momentum. But there are, business or economic momentum factors that you could look at with a individual company, whether that's earnings revisions, right? We tend to look at earnings revisions and define them as their own thing, but it's really just a factor of sentiment, right? Of momentum sentiment. So you'll see that as another kind of definition of momentum, or it could be integrated in. And then you can have shorter term momentum, right? A 3-month, 6-month, what have you. But generally, we want to look at it in that 12 - 1 momentum. And then so just to think about how it's worked and how these things have tend to reverse over time. The way we like to look at momentum from a portfolio construction or thinking about a factor composite is I like to look at momentum blended within other factors because it can kind of smooth the transition from one regime to another. I've never been a huge proponent of just focusing on momentum on its own, right? As a fundamental investor who has a penchant for the quant, right? I tend to mix those things, and just completely ignoring the fundamentals or valuation is a tough ask for me. That said, to answer your question on could this regime change, or what are some of the risks inherent with momentum, I think the easiest way to think about it is as momentum continues to work, right? More and more people pile in, and more people are chasing that momentum, and eventually there's not anyone else left to buy, right? So everybody's on the same side of the boat. So that's kind of how I think about the momentum unwinds, or the risk inherent with a really stretched, really crowded momentum factor.
Yeah, the crowding effect, I think, is impossible to ignore. That tends to be how these things kind of reach their crescendo. I would add, great overview on momentum. I also think there's an element here of the market structurally has changed, particularly over the last 10, 15 years, with passive, with buybacks becoming bigger and bigger. And I think that kind of adds fuel to it. Now there are buyback factors, things like that, but I think that dynamic structurally has played a role, right? At least a little bit in what we're seeing in kind of momentum doing so well over kind of these multi-year timeframes. I guess real quick follow-up, what would you say are some indicators that we should be paying maybe closer attention to for signs of potential factor rotation or regime change?
Yeah, I think, where I tend to think about it rather simplistically, like there's obviously a lot of great research and data around crowding, around, how extended some of these stocks within a momentum basket have done. I also like to look at, the correlation between your market returns, your momentum returns, and then other kind of related factors like beta or volatility. And then, really just started to think about what at an individual name level, and won't name any names, but an individual name or theme that is in trend right now, right? When there's good news that doesn't work, right? When you don't get the reaction, because a big piece of momentum too is there's so much expectations tied into it. And those expectations can get so lofty that even news, right, I call it an earnings print or whatever, can not be good enough. They raised their guidance, they've done everything that you would expect, and that 2, 3, 4 quarters ago was causing that particular name to skyrocket. It doesn't work, right? So those are when, on one instance or one, occasion of that, maybe not, right? Maybe that's not like, the regime is shifting, but as you see it over and over with a few different names within the trend, and then obviously just the performance of the factor is generally a good sign there, because the moves downward can be violent. I mean, even just last week we saw, what potentially could be the start of a bit of a, it could be a blip, but it could be an unwind, and we saw how drastic that drawdown was last week.
Yeah, it's interesting. So news failure basically is yes. one big thing you look for. Yeah, and happening kind of in seeing it in more than one name, starting to see maybe a few names within the factors starting to do that. It's okay, that's great. Okay, outside of momentum, when you look across the factor landscape, what's the what's the cleanest message you're getting right now? Are we at a point where the dispersion across factors is creating some opportunities?
Yeah, I think so. I think that there's been a lot of, right, like we talk about this quite a bit. There's your AI basket, and that has all the factors that are explaining the AI basket, right? And there's a bunch of different ways to slice up that basket. You have your hyperscalers, you have your semiconductors. Within semiconductors, you have memory versus high compute. That said, I think then there's your non-AI. So it's really, if you're not in the AI basket, you're not in the AI basket. And those are like a clean bifurcation. One of the things I've been thinking about too is, well, maybe there's obviously the AI at risk, or companies that may be disrupted by AI, and the software names have been a big, negative beneficiary of that factor. But what I've been trying to think about is, or what are some AI insulated type businesses or names, and where you think about, okay, whatever happens with AI, it could be the greatest thing that everyone is saying it could be, or it could be just another step change in technological advancement. These companies over here may not do any different one way or the other, right? So kind of thinking about that AI insulated basket. And then, so you kind of, if you can sort out some opportunities like that, then you can start to think of, okay, well, have some of these maybe gotten thrown out as if they're an AI at risk, or a disrupted industry. And so you can do that by kind of sorting, okay, they're not in the AI basket, but we think they're AI insulated, and they're, momentum, they've got low momentum, right? So low momentum, it may actually mean that their valuation looks nice because they've sold off. And then you can look at a quality factor. So like, those are the kind of opportunities we're looking for, while individually looking at any names that within those buckets of momentum have maybe gotten a bit stretched beyond any kind of realistic expectations that we could make. So those are the opportunities. So yes, to answer your question simply, absolutely, a lot of opportunities to, even just within your your current portfolio. You can take your current portfolio and do this, so you're not necessarily thinking about having to find a new name or something like that, or a new investment, right? You could just take your current portfolio and probably adjust just to have some risk management in there.
Yeah, so thinking a little bit more about the path to get there won't necessarily be linear, say on AI or whatever. So thinking about kind of the different ways you get there, which might take some steps here and there, and factors can probably take advantage of that, right?
Yeah, absolutely. I think it can definitely, and that's one of the primary ways that we like to leverage factors in our work here at LPL, is to help us quickly identify and tell us a story in data very quickly.
Yeah. All right, so we covered a lot of ground today. Tom, as we close, let me ask you this: from a risk management perspective or standpoint, what's the biggest mistake you think investors could be making right now when it comes to factor exposure?
Yeah, and I touched on this before. I'll preface before that some investors are intentionally making this risk, taking this bet or this risk on being all in. But I think the biggest mistake folks could be making is thinking they're more diversified, thinking they're less correlated across their portfolio than they really are, because they're not, maybe they're at benchmark weights on the traditional AI names, but they've been following a lot of the other businesses who have high earnings revisions, and think that hey, I've got exposure across a bunch of different risks. But when you really break it down, if you do some cross-factor correlations and you look at where the risks are driven, it's all coming from the same thing. It's the same trade. And I think that's the big risk. And ultimately, that's what drives these momentum unwinds in a lot of ways, is that, once everyone in the market is in it, even if they don't know they're in it, right? So they're unknowingly all in the same trade. And as they start to break down, they've got stops, they've got risk management, whatever it may be. And it just kind of continues to unwind from there. So I think that's the biggest mistake folks are making in this market right now, that could be explained with some factor analysis. And this stuff has gotten pretty, I'd say, compute and software has enabled a wide range of investors, from retail, wealth management advisors, all the way up to institutional investors. Like, it used to be the domain of just your hedge funds and your big institutions to have access to these risk models and everything. But I think it's gotten to a point where a lot of people can do these. I like to think of them as an X-ray, or a checkup, if you will, on what factors you're exposed to relative to either your benchmark or just absolute, and what the correlations of those are, so you can kind of get a better understanding of how concentrated your bets may be without you knowing.
Yeah. I mean, know your position, know what you own. I think always timely advice, right?
Yep.
All right. I think we can wrap things up there. Some great insights, Tom. Really appreciate you taking the time to stop by this week. And thank you to everyone for listening. Please be sure to join us again next week for another edition of Market Signals.